Here's a recap of our top story. Singapore narrowly escapes a technical recession after advanced GDP estimates for the third quarter show that the economy expanded 0.6% on quarter.
Well, that reversed the 2.7% contraction that we saw in Q2. And meanwhile, the central bank has eased its monetary policy for the first time in over 3 years. And Steve, who have we got tonight?
Well, to help us make sense of it all is Barnabas Gan, economist at the United Overseas Bank. Barnabas, thanks so much for coming in.
Thank you. Thank you for having me.
So take us through it then. Your initial assessment of the numbers that we've seen. Is your cup half full or half empty? Or should we be happy?
Well, I think for the general public right now, I think a good thing to know is that the Singapore economy has avoided the big R word, which is the recession. You know, at least for the second quarter, although we have seen a minus 2.7% growth, we actually saw a positive 0.6% on the quarter-on-quarter basis growth.
Okay, so you're overall quite happy, I suppose?
I am generally happy and comfortable with the numbers, even though it is a slowdown, no doubt. No doubt it's a slowdown. But at least despite the fact that the global trade has been slowing and the manufacturing growth has been slowing, we still inched out a positive growth.
So Barnabas, you mentioned manufacturing, and I want to get your take on that because we anticipated that manufacturing was going to be a drag on these numbers, and indeed that is what we saw with a third straight quarter year-on-year contraction in manufacturing. Should we be concerned about the performance here going forward?
I think for the manufacturing sector, that is also somewhat lukewarm. Specific sectors or clusters in the manufacturing economy have clearly seen headwinds given the fact, given the US-China trade tensions. And what I mean by sectors would likely be from the electronic sector as well as the precision engineering sector. And for those in the market, we know that these are semiconductors-related clusters, you know, and given the fact there's a global electronic cycle slowdown, as well as trade headwinds, it is of no surprise that these sectors have seen some softness since, last year.
Any light at the end of the tunnel for manufacturing, though, at all?
Good question. I think the entire notion of Singapore's growth, at least from the external environment, it's largely predicated or tangent on how the US-China trade tensions and external developments actually progress from now on.
Okay, so it's going to be a wait and see.
So looking at that bigger picture then of how Singapore sort of is impacted by China-US trade relations or the tensions impact, we're just sort of in a very passive position?
Well, I think there is nothing we can really do, I suppose. Singapore is a price taker, and more importantly, we are extremely reliant on the global economy, on trade. You know, just numbers alone, we are about 200% of GDP, you know, when it comes to accounting for total trade of Singapore. That's just behind Hong Kong, you know, at 300%, you know, so we are the second largest global economy that is highly reliant on global trade. So given the fact that we are so highly exposed to how trade winds actually perform globally, you know, we would have to see.
Barnabas, let's get your take on what we saw with the central bank easing monetary policy today. Not all analysts anticipated that. Some did, some didn't, but it's the first time in 3 years. Should we be concerned about that at all?
Well, the MAS has actually reduced its slope slightly. And from what we see is that we actually perceive the previous appreciation to be at 1%. So the downgrade of the slope of a slightly easing of the policy means that the appreciation should be about 0.5%. But I think just a way of statistics, for the layman right now, what we can see is that the rate of appreciation would likely be kept at a more gentler slope, and which actually means that the room for the Sing dollar to appreciate further from henceforth, it's now kept going forward, which could actually mean that the Sing dollar could actually see further softness in time to come.
So it makes Sing dollar, you know, sort of products and services more competitive.
That's right. That's right.
And could you elaborate on something you just mentioned there about the man on the street? How does sort of all the things that we've been discussing, how does that impact the average Singaporean?
Okay, somewhat technical right here. I mean, the sense that the Sing dollar has been trending above the midpoint. You know, so that actually means that with the easing of the slope slightly, that means that the hit move, more so the room for the dollar to actually appreciate further, it's now being kept. And that means that there's more room for the Sing dollar to actually depreciate further into the rest of the year and into 2020. You know, so that actually could mean that the Sing dollar would be cheaper versus the rest of the regional currencies as well as the US dollar.
Okay, so that helps exports, but not necessarily...
Yeah, so for manufacturers or exporters in Singapore, we would see a more competitive price when it comes to exporting goods. You know, but for the layman, more so on the streets, inflation is actually likely benign. You know, so that means that the weakening Sing dollar may not have much of an effect when it comes to purchasing power.
So apart from the monetary easing that we've seen the central bank get to today, any other arrows, you know, in the quiver that they can pull out to help stimulate growth for the economy?
Well, I think if you just look at the budget that has been rolled out over the last 4 years, you know, and the upcoming budget next year would be the 5th year of the 5-year cycle, you know, and if you crunch the numbers, that means that the Singapore government has about 10 to 15 billion worth of surplus that has been accumulated over the last 4 years. And if they do roll out something, I mean, back in history, back in the global financial crisis, they actually rolled out a $20.5 billion worth of resilient package. That was then. I'm not so sure if they're going to do it now into the next year, but if there is a need to, that would be the next quiver.
Now, we've narrowly missed, Barnabas, we've narrowly missed a recession this time around. Going forward, are we still, I mean, seeing as you mentioned, we're sort of at the mercy of sort of bigger powers at play. Where do you sort of see Singapore sort of landing the next time we start looking at these numbers?
Well, you know, I'm a guy of a glass half full.
Yes.
Right. So
we established that earlier, yes.
Yeah, so what I do see is that inflation and growth will likely pick up into 2020. You know, at least from the analysts on the street, we are actually looking for both numbers to pick up, given the fact that the US-China trade tensions could actually see some improvements going forward.
Okay, well, thank you, Barnabas, for coming in, talking us through it all. Barnabas Gan, economist at United Overseas Bank.